All right. Well, welcome. So our last meetup was in January, but before that was November. So we do these monthly meetups. The fourth Monday of each month, other than December. And so what y'all just experienced was our networking breakout groups. So we usually do that to about 7:15 p.m. I feel like it's really important to have those breakout groups in the beginning. It breaks the ice, gets people comfortable, open to talking, et cetera. And then we do our guest presentation. And we've had incredible guests. Today is no exception, with CoStar coming and add a lot of value on the market information for both Austin and San Antonio. But we have other syndicators and sponsors. We've had passive investors, et cetera, join. We've had tax consultants. I've had my Security Exchange Commission, SEC attorney talk about the private placement memorandum. So we've tried to provide so much education. I've done a look into like how I underwrite deals and what gets me excited about a deal, et cetera. So please continue to join, spread the word. A little bit about myself. My name is Wayne Courreges. I am based out of Central Texas. I'm born and raised in Austin, Texas. Joined the Marine Corps in 2003. From 2003 to 2007, served in the Marine Corps. And then, if y'all can mute, let me see here. Cool. Yeah, so based out of Austin, but went in the Marine Corps, and then when I got out of the Marine Corps, I got into commercial real estate in Washington, D.C. So I've been doing this, it'll be 15 years in June, focusing on repositioning. My comfort zone and my enjoyment is day one of owning a property. So that's what I enjoy most, is that asset management piece, just because that's what I've been, bred to do, or, like it's my training. So my son is in the upper corner. His name is Hunter. Lower left is Lily, Emma, and then my wife, Jennifer. So they're a big part of this, big support of what we're doing. But we syndicate deals. We grow our investors' wealth through partnering and pooling our money together to buy bigger and better assets. And that's through partners, and that's through finding our own deals. I try to provide a lot of value. One is this meetup. We do monthly, but also doing a weekly podcast. And you can find that podcast at CREI-partners.castos.com. And then if you go to my website, CREIPartners.com/ebook, I've got a lot of information there. And then you can check out the ebook as well. I've also got a Facebook group that would love for everybody to join. So with that said, enough about me, because I know you are here to hear from CoStar, but I want to introduce Sam and Danny. So let's start with Sam. So Sam Tenenbaum is Director of Analytics and Market Economist, specializing in market research and economics for CoStar. CoStar is the world's largest commercial real estate data and analytics company. Sam leads research for Central Texas, where he focuses on predictive analytics, risk assessment, and multi-sector market research for institutional, family office, and private investor clients. He's been quoted in news publications such as the Washington Post and the Austin Business Journal. He's often asked to speak at events on local, regional, and national trends by organizations, including CCIM and the Texas Apartment Association, as well as regularly keeping CoStar's broker, investor, and lender clients up to date. He previously directed Latin America market research and risk assessment for GID Investment Advisors. I've known Sam for a few years now, and he's just a top-notch guy, and so grateful and appreciative that he's willing to talk to us today, as I know he's talked to us previously. So Sam, thanks for joining us. And then Danny.
Wayne, by the way, your $20 is in the mail for that intro.
Yeah. And you're just my dad always says, good blood. You're good blood. So Sam, thanks for being on. And then Danny, who I have not met in person, but I'm gonna make it to San Antonio to connect. But Danny is a CoStar's Group's senior analyst for San Antonio. He's a background in urban economics and provides presentations and reports for audiences around Texas, interested in knowing more about commercial real estate in the Alamo City. He previously served as an economic development specialist for the city of San Antonio, where he co-authored the city's international business development strategy. Prior to that, he co-wrote and contributed to the number of city plans in San Antonio, Fort Worth, Kerrville, and South Padre Island during his time at civil engineering firm Kimley Horn and downtown partnership Centro San Antonio. He's been quoted for his writing featured in the New York Times, San Antonio Business Journal, and other local publications. He's a graduate of the University of Texas at Austin's Lyndon B. Johnson School of Public Affairs, Hook'em Horns, where he studied graduate level urban economics and management and earned his master's degree in public policy. Danny is a CoStar's Group's senior analyst for San Antonio. So I'm super excited, guys, for y'all to be on. I'm gonna stop share and I'm gonna turn it over to you and Sam and go from there. And again, while we're waiting, please put in questions and stuff in the chat box. Afterwards, we're going to be very open to conversations, Q&A, et cetera. So,
cool. Danny, while you're getting that pulled up, Wayne, thank you for that introduction. For those that aren't familiar with CoStar, I know that was a little bit in my bio, but we're a real estate data and information company. We own LoopNet and apartments.com and a bunch of other sites, homes.com, which will soon overtake Zillow. I'm just kidding. I hope so, at least. But we're actively investing in real estate and marketplaces and things like that. And so while we're pulling this up here, we're going to start with sort of a national economic overview. Then we'll focus in on Austin and San Antonio's economies, blow back out to the national apartment market and some trends we're seeing at the macro level, and then dive into each individual market. We've got a lot of content, so we're going to go pretty quickly. But as Wayne said, feel free to put questions in the chat. We can revisit charts later on in the presentation during the Q&A portion, whatever you'd like. So Danny, let's flip to slide 1 here. So the best way to start an economic update is by talking about what's happening with GDP. We've seen a huge rebound in GDP across the country. We've actually surpassed the pre-pandemic level in pretty late 2020, early 2021. And in fact, we're actually above the trend for where we would be had the pandemic not happened. You can see that orange line is the extension of the trend we were seeing prior to the pandemic. If you continue to grow that, and we look at where we are relative to where we would be had the pandemic not happened, we're seeing more economic output across the US. One of the important pieces to the puzzle of what we've seen is, especially here in the multifamily market, is the increased savings rate. This was a big story in 2020 and 2021. We were, out there talking about the revenge travel that was going to happen in 2021. Unfortunately, COVID kind of sapped a lot of the room out of the revenge travel trend. But we've seen a lot of people purchase a lot of goods as a result of this built-up saving. As this next chart will kind of illuminate here. So this is what we're here looking at is inflation split out between goods and services. And the best way to think about this, it's a big topic on everybody's mind, of course. So CPI is effectively it's an annoying term, but the best way to think of it is a basket of goods. It's an assortment of things, and you measure the price change of those things. So because it's a basket of things, you can kind of split those things out between goods and services. And what we've seen for the most part driving the inflation higher is goods pricing, right? We've seen huge increases on things like used cars as a function of supply chain issues. This is sort of, the thing that the Fed is watching really closely as they look at interest rates. And obviously with big inflation on the good side, that's room for caution. But what I think is even more concerning for the Fed is that gray line there, which is services inflation. And so that's the result of wage pressures and all sorts of other pieces to the puzzle here. And that's where things get a little more nuanced and complicated for the Fed, because goods, you can sort of back into supply chain issues, semiconductor shortages, COVID in Southeast Asia, where a lot of things get, manufactured, and all sorts of other residual impacts of supply chain. And that's going to affect the goods piece. What is a little more elastic is the services. You can scale those up and scale those down pretty quickly. And the fact that we've seen rise in service pricing over the last year to the tune of, a little over almost 5% or so is a little bit concerning, as we look into our crystal ball here. Naturally, we can't talk about an economic update without updating everyone on the status of jobs, since jobs drive, real estate. So we broke this out by industry. You can see that the initial hit are those blue bars, how many jobs we lost in the initial days of the pandemic and recession. And the gray bars are how many we've bounced back. You can see the biggest gap remains at the top, the accommodation and food services sector. The two biggest and only real places where we've seen significant bounce back are the transportation and warehousing sector, the warehouse jobs basically, and the professional, scientific, and technical services, And those are sort of your high-end office work, your lawyers, your architects, those kinds of, and in some cases to tech, which we'll talk about when it comes to Austin, certainly. And naturally, as I mentioned earlier, when it came to the services inflation, we're seeing a lot of wage pressure. This is a measure of wages here with average hourly earnings. We're seeing earnings up about 5% or so across all industries. If you look at that blue line, that total private, you can see that's higher than it's ever been. We're seeing huge wage pressure, and that's driving a lot of service price changes, but also is encouraging for the multifamily space, because as more people have more money, they can spend more on rent at the end of the day. Pretty simple relationship there. As we look at where we are today here in Central Texas, as we move to the Central Texas portion of the economic update here, we can benchmark both of these markets relative to the US when it comes to bouncing back from the pandemic drop. And you can see both Austin and San Antonio have seen a strong bounce back in jobs since the beginning of the pandemic. And we've seen a really strong economic recovery here in Central Texas, and it's driven by all the kinds of things that make our markets work. In fact, if you put it into perspective, if you put those recoveries into perspective here, obviously we're well ahead of the nation. But if you look, we're one of only a handful of markets that have actually recovered back to pre-pandemic levels. You look at Austin kind of tied with Salt Lake City for the largest increase relative to pre-pandemic levels. But you look at San Antonio ahead of Nashville and Denver and Atlanta, a lot of other markets that people really like. San Antonio is punching way above its weight class and sort of oft forgotten for how good of an economy and economic and population growth it has. It's doing incredibly well.
Agreed. And I'm here to talk to you all about that, of course. Like many cities, of course, San Antonio has not had an even job recovery, right? I mean, a lot of sectors such as education and health services, mining and construction, that's largely the oil and gas industry here in Texas, still in the red a bit since February 2020, But obviously the major sector that's been getting on the press, the major sector that's been posting a lot of the gains is your professional and business services, right? And that's a lot of jobs that can be done remotely. That's a lot of jobs that are, white collar jobs, office using jobs that for a period of time, at least, we're no longer using the office. So clearly a lot of gains there. And you'll see that too here in Austin. And I'll go ahead and let Sam speak a little on that.
Yeah, that's a good point. The same kind of story here. Same kind of story here in Austin, where we've got, the leisure and hospitality kind of sector struggling. That's bars, restaurants, hotels. Whereas on the other hand, you've got trade, transportation, and warehousing, or utilities here doing incredibly well. And you've got, office using jobs like professional business services, financial activities, and information doing exceptionally well. We're seeing really strong bounce back in high knowledge, high skill, high wage jobs here in Austin. And in fact, if you put all of these into perspective, which we're going to do a lot here today, Austin and San Antonio rank incredibly high when it comes to those kinds of jobs. If you look, San Antonio, depending on the month, will flip back and forth with Memphis for number 2 in the nation. But the reality is that this sort of mega region here in the Austin-San Antonio corridor has seen some of the strongest economic bounce back of any place in the country. And in some cases, by far and away, a much higher amount than anywhere else. So before we go in and talk to you about how fast rents have gone up in Austin and San Antonio and all the other, relative implications, I want to set the backdrop with the broader US narrative here. And so when we start here at the national level, we see those orange bars, which are net demand for apartments, has been incredibly strong over the last year. Those three quarters there, first quarter, second quarter, and third quarter of 2021, some of the strongest apartment rental demand we've ever seen in history. Really incredible. We saw vacancies compressed by 200 plus basis points pretty much in a year, which has never happened. You can see we've kind of puttered around 6.5%, give or take a little bit for most of the last decade. But over the last year, we've reset to sub 5% vacancy at the national level, which is really tight. And generally speaking, our outlook, is to have vacancies kind of float back. But the reality is we're not building a ton more apartments than we were prior to the pandemic, and we've just reset our vacancy rate to 2% lower than where it was before, which is really impressive when you start to look at the broader backdrop of what's happened on the multifamily front. And obviously, when you compress your vacancies that much, you're going to see substantial rent growth. And so at the national level, we saw about 11% rent growth in 2021. That's really strong. That's the strongest we've ever seen since we started collecting data back in 2000. Obviously, we'd love to have data that goes back even further, but I would venture to guess that we've never seen this level of rent growth ever in the US history. This data hasn't quite made its way all the way through to the inflation data, which is another sort of indicator that is lagging behind real-time data here. But we've seen incredibly strong demand, which is obviously generating incredibly strong rent growth. And there are a few other reasons behind that, though. It's not just the strong vacancy compression. If we look here, what we're looking at here is the single family home price index. That's the gray line there, and the housing affordability index. And obviously, we've seen a huge rise in single family prices. For those that don't know or aren't here in Austin, over the last year during the summer, we saw price increases of 40+%. Right now, I think in the city of Austin, we have 0.3 or 0.2 months of inventory on market. Substantial price increases at unprecedented levels, which is really just helping insulate landlords, right? I mean, if your exit opportunity is to go buy a house from renting and house prices just went up 40%, well, all of a sudden now there's a lot of people who might not be able to go buy that house and still have to rent for a while. Part of the reason for that is we just aren't building a lot of single family housing. So this is housing starts by whether they're single family or multifamily housing. The blue line you can see is kind of rebounded nicely from the last recession back in the early 2010s, 2009, 2010. Kind of in line with where we were, back in the mid 2000s as well. But you look at the huge decline in the single family home building, we just have this huge gap in the amount of demand for single family housing compared to the amount of single family housing that exists in this country. And that's really generating a lot of those price increases. But also on the multifamily front, it's not as if we're building a ton more multifamily housing as we were back in the 2000s either, despite the fact that our population is significantly larger than it was back then too. Right. And so we have this huge housing gap that's been created, which is helping, push those rents further. The other confounding thing here is what we call replacement costs. And so it's basically the cost it would be to replace your house or your apartment building, what have you. And those prices have risen substantially. This is just lumber futures. So this is lumber pricing effectively. It's one measure. Obviously, if you're going to build an apartment building at scale, you're going to have to source 400 toilets, roofing, a lot more than just lumber, but it's a pretty good proxy for how expensive it is today to build more multifamily housing in this country, or just housing in general. And it is very expensive. You saw the drop off in the pricing there in late 2021, but it's rebounded since. It's going to be volatile. Supply chains are a weird thing. The fact that our economy is globalized has made all of this a lot harder to untangle and make a direct line to customers. And so we're seeing things like, James Hardie not selling Hardie board to multifamily developers in Houston because there's so much single family demand for Hardie board, just as an example of some of the implications of these kinds of problems. The other piece to this problem is the fact that not only have we not recovered all of our construction employment back to the early 2000s, back to pre-recession levels. You see that blue line there. We're not back to that pre-pandemic peak. We're not even close to being back to the mid 2000s peak before the great financial crisis. We have a huge shortage of construction labor in this country that isn't going to be solved overnight. I have a lot of anecdotes about this, but the reality is we're seeing a huge pullback in construction employment, and that only exacerbates pricing for construction across the country.
Thanks for that broader national context, Sam. I'm going to start with apartment search activity. Some really cool data that we have with our partners at apartments.com. So for those of y'all that aren't maybe aware of it, CoStar and apartments.com are part of the same team, the same corporate umbrella, if you will. So we actually can see a year-over-year change for search activity and kind of gauge, I guess you could say, interest in a particular market or a particular part of town. But basically, when someone clicks on an apartment, we can see that here and kind of lay that out for you. And you could probably see where some seasonal patterns have emerged, right? Or where there is some seasonality. Obviously, you could probably see the big freeze in Texas last year in 2021. Search activity was a little down, of course. Hard to look for an apartment when you don't have power to your own apartment, probably. But other than that, 25% year-over-year increase in San Antonio for multifamily search activity. So that's definitely high, and that's not something that we see on a normal year. And you can really see what that did for demand too, right? Those like thin yellow bars right there. So vacancies in San Antonio for multifamily fell from 9.5% to just about 5%, or more like 5.5%, but it was cut almost in half, and that's the fourth steepest decline in the nation. So San Antonio, in some ways, may not get the same amount of press as a lot of other investor favorite cities, but it definitely is the kind of city where you're going to see strong demand, not met with the same level of supply. At least that's been the story this past year. So it's been a market that's outperformed in many ways, and you can actually see in terms of occupancy change, Austin and San Antonio, right there, among two other Florida cities, or three really, with Miami just behind San Antonio, leading the country in occupancy change. So San Antonio a little closer to 4%, Austin a little closer to maybe 4.5%, but still tremendous change in occupancy, which is basically the inverse of that vacancy you saw there, that tremendous vacancy and compression here locally. But the black line is the US average, and that's at about 2.1% for 2021. It was at about 2.1%. So really strong absorption, like I said before, just kind of given the time of what we've got today. I don't want to dwell too much on this, but tremendous demand, of course, as I said before, net absorption more than 5% over the last 4 quarters for San Antonio. So that's a healthy market, and Austin leading the nation pretty much, tied with Orlando there in terms of absorption over the past 4 quarters rather. So vacancy by star rating, you can see how a lot of people maybe gravitated towards higher end units, a lot of 4 and 5 star units. Those were some of the ones that we saw. All really units of all star ratings saw vacancies dip down and compress quite a bit, but really 4 and 5 stars were among some of the steepest declines we saw. Really all across the board, people were interested in renting an apartment, which gave landlords a lot of ability to push rents higher than they had been throughout all of 2020 and in many recent years. So what I call the great vacancy compression, right? That translated to some large increases. And for San Antonio, it was about 13-14% year over year for 2021. So definitely not a bad time to be a landlord in San Antonio, you could say. But in 2020, another thing I'd like to say too is while 2021 may have kind of stole the show with those tremendous increases in rents there, 14% year over year, 2020 here in the Alamo City, we didn't see much of a decline at all. So kind of treading water, while the nation as a whole did see rents in retreat a little bit, at least by a percentage point by the end of 2020. So. And you can see a lot of the rent gains were with your larger units. This should be no surprise because a lot of people were seeking space, right? They might have been seeking space for a home office. A lot of millennials are coming of age. It's a large generational cohort that is coming of age, starting their own households, their own families. They'll need space, at least maybe more than a studio can provide. So studios did not see the biggest increases, but definitely it was led by your your 1 and 2s, and to a lesser extent 3s, because at that point you're starting to get competitive with single family homes, and someone might just opt for home buying, which is what we saw this past year, right? So rent growth by star rating was also high all across the board. Don't want to dwell too much on this because there's a little bit more exciting stuff to talk about with our forecast. So kind of moving from observed vacancy to forecasted vacancy, we can see that CoStar's vacancy forecast calls for some loosening in the market. Maybe moving up somewhat over the next few years, at least slightly. The market was red hot, right? But we don't envision that continuing forever. Despite it being an impressive show of strength in the rental market, probably not going to last forever. There's a lot of supply currently underway, at least in the apartment market, and that will encourage some sort of normalization, right? So that means your vacancies will probably start to tick up maybe later this year a little bit, and maybe beyond for multifamily. So multifamily rent growth right now currently stands at about 12% on the year. It's the high for 2022 relative to the aggregate. Again, it won't last forever. We're still going to probably see good amount of rent gains throughout this year, but our forecast for rent is calling for that to be a little lower over time, and kind of return to that baseline that we talked about, that normalization in the apartment market. 13% year-over-year rents are great if you're a landlord, but it's unrealistic to expect that every year, whether you're in Texas or not, unfortunately. So San Antonio obviously has a lot of rent growth. It's been seen in other major metros as well. I like this chart because it shows kind of where we are relative to other metros, and you can see that all major metros really posted some really impressive rent gains. A lot of Florida cities you can see, and Texas cities up there as well, Austin. So 20% on the year in Austin, and 13% on the year in San Antonio. So really, I mean, it's really impressive rent gains we've seen here, at least in San Antonio, but it's not record. It is record-breaking locally, but it's not necessarily the highest rents that we've seen across the nation in terms of gains. So, and this is actually something I like to point to as well, because you can see that one of the major draws to San Antonio, one of the major draws to our city, is its affordability, and we're not losing that edge, right? So obviously a big increase over the past year, you can see in that red line, but still that gap between the nation and the city persists, right? It's still there, and in many ways it's widening in terms of absolute dollar value. So I personally don't think San Antonio is going to be losing its affordability edge anytime soon, and that's going to continue to draw renters and investors probably alike. Yeah. And kind of breaking this down by the part of town, submarkets as we call them, you can see that supply and rent growth wasn't the same in every single submarket in every single part of town or county. Downtown added the most supply in terms of just its percentage of existing supply before, so 10%. It grew in just 1 year, and that's pretty consistent with what downtown has been adding over the past decade. For those of y'all unfamiliar with San Antonio, the mayor had this huge initiative called the Decade of Downtown last decade, and that basically that policy initiative led to a lot of supply coming online, a lot of developers taking the plunge and adding units there. So every year, basically over the past decade, that submarket's been adding like 10% every year. So not surprising to see that they're a little below the average there, which for the city, again, was about 13%. In some respects, it could be impressive based on how much they've grown. But you can see suburban areas too have added quite a bit of supply. So your Guadalupe County, that's right next to your high growth suburbs like New Braunfels. New Braunfels is kind of the second biggest city in this area, the San Antonio area, and that's partially in Guadalupe County, and that's probably what you're seeing is a lot of that gross spillover from Comal County, which didn't add too much over to Guadalupe. So this chart is really cool because you can see how a submarket reacts to so much supply. I mean, and currently, you can also see how some submarkets are also reacting if there's no additions to supply. So you can kind of see here maybe where a lot of the demand is, right? A lot of the demand and where the demand is sufficient enough to meet new additions, deliveries. So as I maybe alluded to before, demand was high, but supply was not so high, right? So we had among the fewest net deliveries here in San Antonio compared to other major markets. So 3.7, so a little under 4,000 units in 2021. That's pretty low compared to the amount of new demand we generate here in San Antonio locally. So it's definitely an important part of what we see going on here. And then you can see, obviously, 2020 had a pretty low amount of units under construction. Generally, it's grown over time with the city. 2021, we did see a notable uptick in units under construction. In 2022, we're only seeing that increase. Of course, that hasn't quite translated into deliveries yet because it takes time to build the thing. But basically, yeah, we're seeing more units under construction now than previously. So that may change that limited supply pipeline narrative that I was talking to you all about, especially as, you know, maybe supply chain issues sort themselves out. That'll make construction a lot easier. Yeah. So. And then one of the last slides I wanted to show y'all is investor interest. So transaction volume. It was record breaking here. So in 2019, San Antonio was the 24th biggest multifamily investment market. In 2021, only 2 years later, it was the 13th. So multifamily investment has skyrocketed everywhere, like I said, but especially here in San Antonio and a lot of other cities as well. But you know, we're seeing a lot more national multifamily attention on this particular market. So we're no longer off the radar for many institutional investors, if you will. And cap rates are continuing to trend down, even in a relatively affordable market like San Antonio. Cap rates do continue to trend down, maybe not as down as Austin, which I'll kind of hand off to Sam here for right now. But basically, the story is pretty similar here in terms of, you know, you're seeing maybe, I don't know, like 4% cap rates, which may before have been nowhere near that. But I'll hand it off to Sam to talk about Austin and what they're seeing.
Thanks, Danny. And so we're going to look at a lot of the same kind of charts for Austin. So I won't have to, you know, spend a bunch of time to kind of walk through the charts with you because Danny did such a great job. But if we flip to the first one here, we'll start just like Danny did with search activity. And you can see in Austin, we saw about a 34% increase year over year in terms of search activity with much of the same trends, just a little more volatile. One of the sort of more normalizing things that's happening towards the end of the year last year was sort of these normal seasonal pressures that happen in this market. There are University of Texas obviously being a pretty big piece to the Austin puzzle here, means that seasonal effects are a little more normalized here than they are in other markets around the country. If we flip to the next one here, you know, we can see that the same kinds of things happen. So we saw a huge increase in search activity, and that led to a lot of demand for apartments. Especially in the second quarter, you can see we topped almost 8,000 units for demand, which is a record. We saw about 20,000 units, as Danny showed in that chart earlier, on the year. That is doubling up a normal year for Austin in terms of demand. But if we look at net deliveries, this is also a market that delivers a fair amount too. And as you can see, we actually doubled up the net deliveries over the last year as well. I know Danny showed the inverse of this chart. So Austin and San Antonio are sort of at the opposite ends of the spectrum. We delivered a lot of units, but we also absorbed a boatload of units as well at the same time. And so that generated huge vacancy compression, as Danny showed earlier with the occupancy change chart. Much like in San Antonio, it's been driven by all different sectors. So we've got the Class C sector coming in with the lowest vacancy, but Class B and C also saw, or sorry, Class A and B also saw significant vacancy compression as well. That's a good thing for a market that builds a lot. You can see the Class A vacancies over time have pretty much since 2015 have hovered plus or minus 10%, which is really high in the grand scheme of things. That means generous use of concessions, all that fun stuff. But over the last year, we've seen those vacancies compress quite a bit. And a little unlike San Antonio, in 2020, Austin really struggled. If we had this same conversation at the beginning of 2021, we had 10,000 units scheduled to deliver. Vacancies were at 10%. Rents are falling year over year. It's not a good time, right? That's a pretty terrifying sort of prospect. But you look at what happened in 2021, and it was a remarkable turnaround. We saw incredible occupancy compression, obviously insulated by some of those themes that we were talking about at the national level here, but at the local level, we look at rent growth up about 19% in 2021, a little over 20%, depending on what time of year you're looking at it. Relative to pre-pandemic levels, we're at about 19% above that trend. But you can see, much like that search activity chart showed earlier, we're seeing a leveling out of rents here. And these are daily rents that we collect. Thanks to apartments.com, we get about 100,000 every day in Austin, give or take, which is just a lot of rent observations. And so because we're seeing that kind of flatten out, that becomes a little more interesting as we head into 2022. One thing that I look for when I analyze Austin is this professional and technical services growth. This is that same thing that we were looking at the national level, professional, scientific, and technical services. This is the same metric here in Austin, and it's a pretty good proxy for tech here in Austin. And you can see it's pretty well correlated with rent growth. If you look back in 2015, in late 2014, early 2015, we started to see rents decline. We started to see decline in job growth among that sector. And then we started to see rent growth fall off shortly thereafter as well. Same thing happened in 2008. Same thing happened back in 2000. Generally speaking, it's a leading indicator for rent growth by about 6-ish months or so, maybe 6 months to a year. The timeline is kind of changing as we emerge from a post-pandemic environment. But the fact that it's up 19% year over year says Austin's doing the thing to attract the high-end jobs that it needs for a market that builds as much as we build here. Now, obviously, when rents are up 20%, that's going to generate a bunch of concerns for affordability. As someone who moved to Austin from Boston about 5-6 years ago or so, it's a little, I don't want to say funny. Funny is not the right word. It is surprising given how inexpensive Austin typically is compared to other expensive markets. So here we're looking at Austin and the nation. Normally we're about $50 to $100 below the nation. Now we're about $60 above the nation. It's really not been a huge change where we are relative to the overall US, especially when you layer in what's happened in some of these other Sunbelt markets here, which you'll see on this next chart. If we overlay DFW, Atlanta, Orlando, if I ask people on this call if Atlanta is expensive, I'm pretty sure the answer would probably be no. But Atlanta has actually seen more rent growth than Austin has. If you look at Atlanta, that yellow line there, it started close to where DFW was back in 2010, and now rents are basically even with Austin, right? You look at Orlando, same kind of story. We've seen huge growth in Orlando rents, in Atlanta rents, and rents across the Sun Belt here. Is Austin more expensive than everywhere else in Texas? Sure, but it's always been. So that's not a new phenomenon or anything like that. But when we overlay California, Danny, if you wouldn't mind flipping to the next one here, we add the Inland Empire, which is one of the cheapest places to live in California. That's a major MSA. You look at the Inland Empire, and the rents there are just infinitely higher than not infinitely. They're significantly higher than where they are in Austin today. In fact, if you look back in 2010, the rents at some points actually cross over each other. In 13 and 14, the rents were about the same, and today they're $250, $300 a month more expensive than they are in Austin. We've just seen a huge shift in the dynamic in the apartment renting space in 2021, but it hasn't thrown the relatives significantly out of whack with each other. And when I look at this chart, what's encouraging to me is most of the rent growth we've seen has been passed on to folks at the higher end of the wage spectrum. If you're in a Class A or a Class B apartment, you're making a lot more than minimum wage generally. And those folks have more of an ability to absorb those rent increases. I won't lie and say that we haven't seen any rent growth in the Class C space, but the fact that we've seen rent growth in the A and B for the most part is encouraging that we're not entering some significant downward spiral in affordability, and we're going to have a huge eviction crisis on our hands in 6 months or a year. If we look at rent growth by submarket here, we see, much like we saw in San Antonio, we've seen a lot of rent growth in the suburbs. This is the case everywhere. We're seeing huge rent growth in the suburbs. The central core of Austin, where we've seen the majority of the supply and the current amount of supply as well, it has been underperforming, although I would hardly say that even at 7% rent growth in central Austin, which is right around where UT is, I would hardly say that that is under, that anyone would be really upset about getting 7% rent growth. I mean, when the market is growing at 20, sure, that's a little low, but 7% rent growth is still quite a lot of rent growth. And the fact that San Marcos and Central Austin lead the market in terms of weak rent growth, or lag the market, I should say, is probably a testament to some of the student housing dynamics that are going on right now. Now, as we look into our forecast, you could make an argument that maybe the demand here is a little more bullish than it should be. But even if we pull back demand a little bit, the fact that we're at 6% vacancy today, plus or minus, really means that there's a lot more room to absorb occupancy or vacancy increases than we have in our base case forecast here. The market is typically around 7 or 8% is sort of a balanced market in Austin, maybe a little bit more tilted towards landlords. And today, our forecast for this by the end of 2026 is about 7%. I think that's probably a little bullish. We're probably going to end up in 2026, with a little bit more of a vacancy increase than that. But the reality is the market we see today is incredibly healthy. This is still one of the strongest economies in the nation, drawing lots of people, job growth, et cetera, to the market, which, should generate pretty sizable demand for the market as we look forward. The one risk factor here, of course, is construction. Like I said, this is a market that builds a lot. You can see as a percentage of our inventory, we have the second most construction of any market in the country, behind Nashville. The number is actually a little bit higher. We're about 24,000 units today instead of 23,000, and it goes up seemingly every day. It is an incredibly compelling time to be building multifamily housing right now from an investment standpoint. If you're buying at a 3.5 cap, which we'll talk about in a second, but you're building to a 5, well, you have a lot more ability to accept rising yield and treasury rates in that environment, and you're not banking on you don't have to bank on incredible rent growth as part of that underwriting. But as Danny alluded to earlier, we're seeing an incredible investment landscape across the country. But here in Austin, we saw about $8 billion worth of assets change hand last year. This is going to be not a great chart for people who rent. A lot of these folks are going to be seeing the full brunt of the markup to asking rent that we're likely to see in 2022. We'll probably see a pretty big pop in NOIs as a result of it. But if we flip to the next chart, we're also going to look at that same cap rate chart, and you can see we've even seen some deals traded at 3 cap, which is incredibly low when it comes to pricing. That's pricing that you might as well be in New York, LA, Boston, San Francisco, maybe not San Francisco right now, but some of those big, more established, typically more liquid markets with a much larger economy than you do here in Austin. And so for a market that has vacancies that are typically much higher than they are in the Inland Empire or San Diego or LA or Boston or New York, it's a much riskier proposition because the rent growth projections have a little more variability, likely have a little more variability to them than they do elsewhere. And that's the last chart we've got for today. I know we're pretty close to the end of, or close to 8 o'clock here, but we're happy to answer any questions, talk about what's going on even more, because we certainly didn't cover everything. That's not true. We covered a lot.
Sam, Danny, thank you for your time. Really great insights. Do you mind if we remove just so we can see everybody, just remove the presentation and then we'll open up to Q&A? Sure. And I'm gonna mute myself. And guys, ladies, this is a conversation. We've got great insights, so take advantage of it. I'll go ahead and mute myself.
I take it that means we answered everybody's questions within the presentation.
If there's no questions, and I'll go ahead. Well, actually, we got a question here from Charles. Yeah, we'll get the deck out if it's okay with Sam and Danny, along with the video to those that are on this call. Hey, one thing you didn't mention, Sam and Danny, I'm just curious about inflation. So I see year over year, the next couple of years, possibly sustaining the same amount of rent growth that we've been seeing. Then it tapers down to more normal market conditions, which I tend to highly agree with. But what are your thoughts on the inflation and sort of how that plays into rent growth and what we're seeing over on the market?
Yeah, I mean, I was doing a presentation with the Austin Apartment Association, and they wanted me to say that all of the rent growth we saw last year was because inflation made their costs go up, so everybody else's costs had to go up with it, which is not true. Obviously, it's an important piece to it, but I think what's more interesting and more nuanced is obviously we saw the goods inflation part early in that presentation, the increase in goods CPI, and we saw what happened to lumber pricing, and so the input costs going up, or the replacement cost if you were to knock it down and rebuild it, or whatever other metric you want to use to evaluate investment, if that's up 20%, 10%, you're probably going to see increases in rents as a result of that factor, right? Because that means that anyone who's building a new building like the one you've got will have to spend that money to realize that and have to charge rents consistent with that number. Now, is a building built in 2019 significantly different than a building built in 2021? From a tenant perspective, not really, right? But if the 2021 building has to charge 20% more than the 2019 building does, and the difference between the two is really minimal, all of a sudden that 2019 building can offer 2021 rents without having to do much of anything to the building, right?
Yeah, great point.
I mean, there's all sorts of other implications for rising inflation when it comes to multifamily investing, but
yeah, we just been
hearing a much longer.
Yeah, in some of these conferences I've attended, it's inflation really benefits multifamily investors, those on this call, right? So
yeah.
What other questions we got out there? What I'll do is I'll also go ahead and stop recording, because sometimes people don't want to be recorded. So I'm gonna go ahead and stop recording.